This is even showing that they're paying 135,000 less in taxes over their retirement. This one thing can save retirees thousands in taxes. This is probably one of the lesser known and discussed retirement topics, something called asset location. As the owner of a wealth management practice and a finance lecturer at a Big Ten university, I can confidently say that almost all my clients and students have never heard of this, but quickly understand the concept and its impact once I explain it. So this is not asset allocation, which is how much of your total investments are in stocks or bonds, but this is asset location, where those stocks and bonds are located. This is all about keeping certain types of assets in certain types of accounts. So here are the big three accounts that we need to know: taxable brokerage, traditional IRAs, and Roth IRAs. The taxable brokerage, I call the flex account with my students. It's flexible in that you can put as much money in or take as much money out. You pay taxes on the dividends, interest, capital gains. And so because of this, there aren't really any cool tax advantages like the retirement accounts, but there are some unique things you can do, but you are paying taxes on an ongoing basis. The traditional IRA, you have no taxes on an ongoing basis, but you do have taxes when you pull money out. The Roth IRA is the reverse. You already pay taxes on the money, so there's no taxes on growth and no tax when you pull the money out. In my experience, what some DIYers and a lot of subpar investment managers get wrong is that they put the same asset allocation between all of the accounts, as in they stick with the 60-40 portfolio in each account and have it invested the same way. That's not the way to do it. You can keep the overall asset allocation while having different asset allocations within each of those accounts. So generally speaking, different investments behave differently, they are taxed differently, and they're used differently. Let's look at this chart that I have. Pardon me for my handwriting. It's never been good, and I'm a lefty, so that just makes everything more challenging. I'm sorry, but stick with me. All right, here's our chart. We have traditional Roth and taxable brokerage, the flex account, and we have the haves and don't haves in this. Let's look at these Roth accounts. So typically these are the last touch accounts in a good retirement plan. So therefore we would want to have investments with the highest level of growth in these Roth IRAs. So think of stocks. This is where you'd want the highest stock allocation, most likely amongst your different accounts. Let's say there are bonds that make sense to have within your Roth IRA, then you'd want the highest yielding bonds given your risk tolerance, since you won't pay taxes on that growth. So a good example would be corporate bonds instead of municipal bonds. Municipal bonds, that income is not subject to federal taxes, but they offer a lower yield as a result. So therefore, you'd want something like corporate bonds instead. If they have the same risk profile to those municipal bonds, corporates, you'd rather have that over muni bonds, because the muni bonds, you're essentially assuming like some of the same risk without the higher yield that you would get elsewhere. So in this, we would also say things not to have. I think munis in general just make no sense in here. I really can't think of a situation where munis make sense to have in a Roth IRA. I'm also going to put in here, don't have too many bonds. Again, every situation is very different. But if this is an account that you're not going to touch for like 20 years, the data would show that you have a very high probability of your stocks not losing money being in this account. Now we're going to look at the traditional IRA here. So because in most retirement plans, in this account, you'll likely be taking money out first, more so than you would be in a Roth account. So you're probably going to have bonds in here. But same thing with some of the haves, if you're going to have bonds, you're going to want to have, let's say, corporates over munis, as in if you're going to have the same risk bond, you're not paying taxes on the interest or the dividends. And so on an ongoing basis, at least. So you're going to want to have the highest yielding bonds given your risk tolerance, and you're not going to want to have munis in here either. The type of stocks you'd have in this account does vary depending on who you are and then maybe the strategies that you like. But let's say you want to have like a safer, not as high growth, but let's say like a dividend stock somewhere, dividend maybe portfolio. In your traditional IRA, that's where it probably would make sense to have that, because in your Roth IRA, you probably want something with a little bit more growth. Again, everyone is different, but because you're not paying taxes on an ongoing basis in the traditional IRA, it can make sense to have your dividends be focused and coming in your traditional IRA. So last, let's look at the taxable brokerage. Again, this is the account that you're going to have the most flexibility with. It can't defer taxes like you can with a traditional IRA, even though there are some unique tax planning things you can do. One important thing is you are going to want to have ETFs instead of mutual funds. And I have another video on my channel that speaks to this, but ETFs are far more tax efficient than mutual funds. The ETFs rarely kick out capital gains without you selling them, whereas mutual funds, they can often have these ongoing capital gain distributions, even if you don't actually sell the mutual fund. So, depending on your tax bracket, this can be an unnecessary tax of up to like 23.8% of the capital gain distribution. So, if you are going to have mutual funds, I would say you probably don't want mutual funds in here in general. Now, again, that's my personal preference compared to ETFs. But also, I would say you're not going to want to have active mutual funds because these ones also will have a higher chance of kicking out capital gains than, let's say, a mutual fund that's tracking an index. Let's say that your plan calls for having some bonds in these accounts. Well, in the flex account, what kind of bond might you want? If you're in a high federal income tax bracket, well, this actually might be the first time that muni bonds make a lot of sense. Whereas before, they didn't in the other accounts because muni bonds, there's no federal income tax with it. But associated with that, you have a lower just overall yield on the type of bond. This can make sense depending on your situation in the taxable brokerage or what I call the flex account. Another thing that might be worthwhile are treasury bonds. And so I actually do this with a lot of my clients right now. Short-term treasury bonds, or we call them bills, are producing quite a bit just given where our yield curve is, and they don't have a state tax on them. Yeah, most of these are state tax exempt. So your after tax yield might be much higher than you expect. Pretty cool, am I right? That's all fine and dandy, but let me show you the impact that actually can have over time. I'll quantify some numbers. All right, we're gonna look at this couple. This is Jack, his middle name Sample for some reason, Smith, and his wife Jill Sample Smith. Okay, not real clients, but the numbers are pretty close. Let's look at Jack and Jill here. All right, Jack's got a $1 million IRA over here on the left. They have a flex investment account. Remember, that's the brokerage account that they own, 500,000, and then Jill has a Roth IRA for 500,000. So their total investments, $2 million. Really simple example. I have their goals. They're going to have retirement expenses of $10,000. And they also are going to have health insurance costs, healthcare costs that they have. And so I'm keeping this as a really simple example just to show you. So over time, let's go look at what things look like. So over time, here's what we have as a projection. Again, these are only projections. We don't know what the future holds, but they'll eventually end up with a little over $2 million in their investment accounts when they retire. But let's go look at their current asset allocation. Here's their current asset allocation, 60-40 across the board. And in their taxable, tax deferred, which is like the traditional IRA, and the tax free, which is the Roth IRA, it's all the same. But what happens if we implement this asset location strategy where we put most of the high growth equities, which we won't touch, in the tax free and maybe even in the taxable, and then we put these bonds that have that allocation be mostly in the traditional IRA because we'll probably be touching those accounts first. Let's go look. We're going to change the equity allocation. We'll change it to our preferred tax-free first, taxable. Let's see what happens. Well, would you look at that? Would you look at that? Because of this, because their overall portfolio is still the same, but their proposed ending strategy results in $200,000 more dollars at the end of their plan than if they just kept a simple pro rata 60-40 across the board. So they still have a 60-40 investment allocation, but by specifying where they're having that 60-40 dispersed between those three different accounts adds a lot of money for them at the end of their life, maybe throughout their life, and maybe even to their heirs. Even the tax efficiency, this is even showing that they're paying $135,000 less in taxes over their retirement. These are not insignificant numbers. These can have a huge impact on future generations or even on your retirement while you're in it. You might be thinking, oh, that's cool, John, but I don't have a really cool fancy software like you. So what am I supposed to do? How can I see how this impacts me? Well, Vanguard did some research and they found that using an asset location strategy could hypothetically add up to 0.6% return annually over time to your investment portfolio. So what you should do, go find your favorite retirement calculator, plug in your numbers, and then increase your return that you would estimate that you would get by 0.6%. I think you'll be surprised at how much that adds over a 30-year retirement. All right, well, what do you think? Have you heard about this before? Are you implementing this in your own retirement plan? Please don't hesitate to comment if you have any questions, or maybe you don't think I did this exactly correct. That's fine. Let me know in the comments. I'm not perfect. And if you expect me to be perfect, well, I think that's an unrealistic expectation. So Let me know if there's anything that you would change up. If you learned something, please like and subscribe. That helps others find the video and it gives me a little bit of an endorphin boost. Godspeed and happy planning.